Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Today is September 18th, 2014, and this is episode 3 of Accredited Investor Markets Radio. I'm Chris Cahill, your host. I'm excited. Our guest today will be Chris Tyrrell, the founder and CEO of OfferBoard Group, a private placement platform for companies seeking equity investments of between $1 million and $25 million from accredited investors. Alicia Purdy will be interviewing him later in the show. But first, some news. Have you heard about the Securities and Exchange Commission's launch of an examination into alternative mutual funds? Firms under investigation include giants like BlackRock and AQR Capital Management, LLC, as well as smaller fund firms. It hit the news just a few days ago. AIMKTS.com has an article about it on the site if you wish to read about it. As you will see if you read the article, the SEC is not suggesting any wrongdoing by anyone. In fact, according to a Wall Street Journal article, the SEC's investigation is to be a fact-finding venture and not a precursor to an enforcement action. Well, what else should I tell you? Well, the August issue of Money Magazine has a few articles I wanted to mention to you. There's a good critical piece about Whole Foods on page 43. A shout out to Ryan DeRousseau for writing it. And if you have a kid getting ready to apply to college, you may want to check out Kim Clark's article, The Best College for Your Money, which starts on page 56. Her top few picks in order, and here they are: Babson College, Webb Institute, MIT, then Princeton, Stanford, Harvard. Enough from me. I weary of my voice. Let's get to Alicia Purdy and her guest.
And now on to the show. Our guest this week is Chris Tyrrell. Chris is the founder and CEO of OfferBoard, an investment platform that helps growing companies raise capital and match investors with companies that interest them. OfferBoard's proprietary patent-pending systems leverage the technology and data of the Australian Small-Scale Offerings Board, the world's oldest small equities funding platform. Chris is also chairman of CrowdFund Intermediary Regulatory Advocates, also known as SAFIRA, an advocacy organization for small securities innovators in the U.S. Chris, welcome to Accredited Investor Markets Radio, and thanks for taking the time to speak with me today.
Alicia, thanks for having me.
Our discussion today is going to center around cutting through the hype, why accredited investors aren't investing in alternative investments. So we're going to jump right in with questions, and let me just ask you, do alternative investments have a stigma in the investing world, and what is the quote-unquote hype?
I think there is a misunderstanding as to what alternative investments are and what their purpose is in an investment portfolio that does cause them, with respect to certain investors, to have a stigma. And if I was to describe that particular stigma, it's that a balance sheet investor, or someone who focuses on particular elements of business fundamentals when making investment decisions, will look at many opportunities for alternative investments and not understand why some of them are receiving the investment capital they're receiving. And what they'll do is they'll blame that on hype. They'll blame it on it's something that's being hyped because when you look at the particular fundamentals of the business, particularly in the startup and tech worlds, they'll look at the fundamentals of the business and they'll say that the fundamentals don't justify making an investment. But alternative investments have as their purpose to be an alternative to the traditional investments that people make, and they're an alternative in a different risk category and in a different return category. And the primary idea around alternative investments is that they have a higher risk profile, but they also have a higher return profile.
Okay, well, that's a great segue actually into my next question for you. Risk is something you'll hear about from people who don't tout alternatives. What are some of the typical arguments that an investor is going to hear about risk? I can name a few off the top of my head: fraud, less government oversight, why that matters, rate of failure. How would you refute some of those major arguments that people make?
Well, it's hard to refute particularly unstated objections, but to look at the general category of private placements and privately held investments, despite there being less oversight, there still is oversight, particularly if a private placement is facilitated by a broker-dealer. There's still norms of minimum due diligence that's required, and the companies often make commitments in connection with the private placement that, while they're not the same as the obligations of a public company to report, still oblige them to report about the company on a periodic basis. So one of the things that investors have to realize is that while they aren't protected in the same way that they might be protected in a public marketplace for specific items, they can request those. Part of that is a negotiation process that occurs between the investors and the company issuing the securities in a private placement that's different than investments in public securities, whereas the public securities are most often take it or leave it transactions. In a private transaction, there's much more negotiating leverage from the on the investor side of the equation, and investors can ask for information rights, disclosures. They should request particular items of due diligence when they're looking at an offering. One of the things that's also very different about platform-facilitated private placements, like those that are facilitated by OfferBoard, is that those private placements, they've already gone through a particular diligence process, because in order to get on the platform, they have to go through a diligence process.
So OfferBoard in and of itself does do a measure of due diligence. Is that what I'm hearing?
The OfferBoard group actually owns a broker-dealer, OfferBoard Securities, and being a broker-dealer, any of the clients that are engaged by OfferBoard Securities have to go through the minimum due diligence that is required by FINRA of all broker-dealers that are engaged in private placement transactions. Additionally, we go above and beyond the minimum requirements and do additional due diligence before allowing companies onto our platform. So yes, the answer to that question is OfferBoard does due diligence before private placement is brought to the marketplace.
Okay. However, I would guess that you'll probably agree with me, that does not negate the investor's obligation to continue to move forward with due diligence. I mean, it sounds like you guys are above and beyond the minimum requirement, but still at the same time, an investor is ultimately responsible for their decision, because they need to have an understanding of what they're getting into.
Absolutely.
Okay.
One of the things that our facilitating initial due diligence does is provide investors with a baseline for making that decision, but by no means is that the only thing that investors should consider when they are making an investment in a private security and an alternative investment on OfferBoard. They should be asking any questions they want. They should. One of the other things about an alternative investment that's different from most public company investments is that the investors have direct access to management. So if they want to ask a question or get more information about something, they should request that. If there's something that doesn't make sense to them, they should ask questions about that. They should explore the investment for themselves. They should ask all the questions that they want answered before they're comfortable making the investment.
And it sounds like it's there for them to do that. That they can explore it through OfferBoard, because you have, like you were just saying, they have access to some of those things that they need. If they want, like you said, they want to ask a question, they want to dig deeper, they can do that because you guys have broker-dealers.
Sure, yes. Our broker-dealer engages the clients that are raising capital on OfferBoard and can facilitate that communication, but also our technology platform allows questions to be asked on the platform itself. So to the extent that they don't want to pick up the phone and talk to someone about it, they can just ask a question directly via the website.
Okay. That makes it a little clearer. Can you give me an example of what sort of placements that you have on OfferBoard if our audience were just wanting to hear something like that directly from you, as opposed to going to look before they even explore? What would pull them in? What sort of things, sort of variety do you have?
So unlike some of the sites that are offering private placements that are publicly advertised online, OfferBoard doesn't have a specific profile of the type of offering and the industry of the offering that we make. So we have a very broad spectrum of offerings, and most of them are larger than the traditional platform facilitated raises. They are $2 to $25 million, and they're in investment markets as broad as sophisticated battery manufacturing to private placements in technology companies to private placements in medical therapies and up a spectrum in between.
Okay, so there's a lot there that's actually trending right now.
Sure. I mean, our initial approach to the marketplace was to look for interesting offerings in broad categories that are the kinds of things that people are looking for. So tech, natural resources, biomedical, and the gamut.
Yeah, that's a lot that I'm hearing about right now on our end. That's very much trending at this point, where people are kind of perking up and paying attention to those specific sectors. So that's great. Now, are the alternatives in general, if you were to sit down with someone who really didn't know a lot, kind of heard some of the negatives, and certainly there's the lion's share of things on the stock market and sort of touting those things, and they wanted to sit down and talk to you about risk, because that's kind of the big fire in the building, is that, oh, they're risky, there's this and that. Are they riskier than traditional investments? And by traditional, I mean the public exchanges.
When we're talking with investors about risk, one of the things that, as a broker-dealer that is not a registered investment advisor, we have to make sure we don't do is advise the person on the particular value of that investment to them. But what I would say as a general comment is that the risk profile should be compared to the reward profile of the investment. If an investor is focused only on the fact that some of these investments have a higher risk profile than a traditional investment in the public markets, what they've also got to understand is that that risk comes with a very different reward profile than the traditional public markets. And so when an investor is just focused on the risk, they're probably going to find that, as a general rule, alternative investments have a higher risk profile than traditional investments. But what they'll also find is that the return profile and the potential return profile of those investments is higher as well. And obviously, it's not our job as a broker or as a private placement platform to specifically make judgments as to the return possibility of any given investment on the platform. Those assessments are for the investors to make before they make an investment. What our job is to do is to assess the claims of the company and do the diligence necessary to make sure that the claims that the company is making as it's offering securities are supported by facts, and to present that information to the investors in an organized way so that they can make that risk assessment for themselves.
Okay, that makes more sense. I was thinking as you were talking that risk really is relative in a lot of ways, and I understand that it's hard to probably explain that, because even outside of just comparing risk to reward, there's a number of other factors that come in to any type of investment that could increase or decrease the risk, and so in any given situation. So it really does make it, so it seems like it kind of comes out in the wash, but OfferBoard certainly at least presents kind of the picture of, here's everything you need to know, now you can make your own decision without getting advisory, so to speak. Are there misconceptions that you're hearing advisors make that are discouraging people away from exploring platforms? I mean, platforms are just abounding right now, and you'll hear both sides of the equation. Is there a common misconception that if you could dispel one thing, you would say, listen, you got to check this out, because what you're hearing is a misconception?
I think if I was to dispel one thing, it would be that somehow platform-based investing is disruptive to the existing financial markets. I think that a lot of the talk around crowdfunding, which is also in the Jobs Act, along with the public advertising of private placements, which is what OfferBoard is doing, the talk around the Jobs Act and crowdfunding has created the impression that the entire point of what's going on in the changes in the financial markets is to disrupt, is to disintermediate the existing financial services infrastructure. And I really think that the power of what the Jobs Act has done, particularly in the area of private placements, is that it's giving new tools to investors and to brokers that specialize in private placements in particular to create better transparency, more information, greater compliance, greater ability to market an offering, and it's really increased the power of capital formation in a lot of really positive ways, but it hasn't disrupted that financial service. It's improved it, it's accelerated it, it's amplified it. And so if I was to be able to dispel one thing about people's perception of platforms and the difference between a platform-based private placement and a traditional private placement, I would say there's not a significant amount of difference other than what I just mentioned, those tools that help increase the value of these offerings. So a platform private placement is, rather than disintermediating the financial services that would have formed that capital in the past, re-intermediating them. It's giving them new tools, new energy, new ability to bring capital together to do good things, to create jobs and to build companies. And that's really what the platform-based marketplaces are now about.
Well, a lot of our audience members and our target audience for sure is the newly minted accredited investor. And so a lot of them don't really understand all that there is out there. So would you just take a minute, and when you hear of investing, most people, I think their mind jumps immediately to, especially when you hear the word platform, they think crowdfunding. And many people don't understand the differences between equity crowdfunding and just regular crowdfunding. But what is a private placement? How does it distinguish from something like crowdfunding where, you can go online, everybody jumps in? Would you explain that to a new accredited investor?
Well, so the first thing I would tell a new accredited investor is you're not alone. Only 6% of the accredited investors who could participate in the private capital markets do. So there's a much larger group of accredited investors who have not ever participated in a private placement than otherwise. What the Jobs Act enabled with respect to private placements, and private placements are a larger marketplace than the public markets. The private placement marketplace is a $1.3 trillion marketplace, and the private placement marketplace is the way in which private companies have raised capital for quite some time. So that part of it is not new. What was made new by the Jobs Act Title II was the ability to advertise those private placements to the public. So now you can advertise private placements online, you can advertise private placements in the New York Times, you can advertise private placements on the radio. A private company can now talk publicly about the fact that it's raising money in a private placement. That's what's new. What's also new is that in order to invest in that private placement, once it's been advertised publicly, you have to be verified as an accredited investor. Before, you could just attest to the fact you were an accredited investor, and that was sufficient to make the investment. Now, the accredited investor status of each investor in a publicly advertised private placement has to be verified. So the only change that has been affected by Title II of the Jobs Act to the old private placement process, the process by which private placements have been occurring for decades, is the change in how they could be advertised. Nothing else fundamentally changed about them other than the accredited verification process.
So now they're going to find out that there's a whole new world out there that they did not have access to.
There's a whole new world, and unless they knew someone who was making a private placement, or they knew a broker who was facilitating a private placement, or they had a pre-existing business relationship with someone who was involved in a private placement, they wouldn't have heard about them. Sometimes even if they did know someone who was involved in a private placement, they wouldn't hear about it because the other person would have to have decided that they had enough of a pre-existing relationship to advertise to them. Because you could only advertise to people with whom you had a pre-existing relationship. So as an example, before the Jobs Act Title II went into effect last September, a friend of mine was doing a private placement, and I'd talked with him in the past about the businesses he was involved in, and I said I'd be interested if he was ever raising capital. And I found out only when he posted to Facebook, oh, I just finished my private placement, I just closed my round. And I contacted him and I said, hey, why didn't you tell me? He said, oh man, I just forgot. I didn't remember that you had expressed an interest in, hearing from me when I was raising capital. But he couldn't post to Facebook before the round was closed because it would have been illegal. It would have been illegal for him to advertise that his private company was raising capital. And that's not true now. Now he could post to Facebook, hey, my company's raising a private round of capital. If you're interested, contact me. So in addition to allowing people to advertise to the public, this is also allowing people to more broadly advertise to their networks. And one of the things that we found from the data that we have is the private placement marketplace, even though people can still advertise publicly, generally is most active within 3 degrees of separation of people who are already involved in the company or its capital raise. So unless a person is a friend of a friend of a friend of someone in the universe of the company, they're still much less likely to participate in the capital raise.
Okay. Well, I appreciate that explanation. I think that it can feel complicated, especially if you don't know what was in the past versus how things have drastically changed with all the new legalities, kind of opening it up, like you said. And so if you would, let's just say I'm an investor who has done well in the public stock market, and I want to diversify, and I want to think about exploring alternatives. What's a good place to start? I mean, is it getting educated? Is it talking to somebody? Is it kind of jumping right in saying, well, I've invested in other areas in the past, I should be fine? Someone who really doesn't know much about alternatives but is very interested, is there a safe place to kind of get the feet wet and try something out to see how it works? Or is that really not the process?
That is the process for some people. Some people who want to make these kinds of investments will join an angel group, and they'll watch the other people in the group examine investments, talk about investments, because really the best way to learn about the private placement process is from someone who's done private placements and who's doing private placements. So the first thing I would suggest to your listeners is that they, if they're interested in participating in this, they probably already know someone who's been involved in a private placement before. And most people who are involved in investing in private placements like to help others who want to invest alongside them, who are interested in the kinds of investments that they invest in, because usually it's not the case that an individual private investor is like a venture capitalist trying to take down an entire round or sees the other investors as highly competitive. The universe of, particularly in the angel community, is very collaborative, very synergistic. They're trying to build capital for these companies. They're trying to bring more people and assets into the companies. And so it's oftentimes the case that someone who's already been participating in this would love someone else new to participate alongside them, to participate in the diligence process, to participate in the examination of the investment before the investment's made, and then once the investment's made, to participate in the life of the company, helping that company grow, bringing customers to that company, bringing other assets, whether they're intellectual or otherwise, to that company, and helping that company be successful, because all of the investors when the company is successful.
As OfferBoard, just if you could explain to our audience, do you have exclusively or not exclusively individuals, institutions, funds? Is it something that a single individual investor can come in and find something that they're interested in? Or is it something that's more geared toward a group of investors? How does that work?
In addition to not narrowing the field of what industries our investments are in, we have not narrowed the field of investors. So we're calling on our institutional contacts, we're using our own networks, we are inviting everyone from a large institution to an individual investor to participate in the offerings on OfferBoard. So the answer to all your questions is yes. Yes, it's institutional. Yes, it's family offices and smaller institutions. And yes, it's individual investors and small groups of investors that want to participate in OfferBoard. And really what we're going through now is the process of building that community of institutions and investors who are coming to our site and who are looking at the investments that are available and who are receiving information about the new investments. We're doing regular webinars by the issuers of securities to talk about their companies and the investment they're trying to raise, and we're inviting the community to participate in those. And so it's our investment opportunities are available to anyone from institutions to private investors. Now, there are some offerings on OfferBoard that when an individual user comes to the site and registers and goes to the list of offerings, they won't see because they're privately listed. Because in addition to facilitating publicly advertised capital raising, we're also facilitating traditional private placements. We're also doing institutional raises for companies that where the company only wants institutional investors, and we're doing those on a private basis. So they won't be listed on the offerings page, but they will be in our system, and we will be sending information out about the listings using our system, but those are marketed privately, not publicly.
Okay. This question is quasi-related to the answer you just gave, but just to allow you some time to clarify, what's new at OfferBoard? You were kind of answering that saying the communities, the groups, that sort of thing. So I was sort of springboarding off of that saying what's new. And if that covered it, that's fine. I just didn't know if you wanted to expound on that at all.
I don't think I have anything to add other than we are regularly releasing information about new deals that are being listed on the platform. Today, we're announcing that we have brought on 9 new bankers from another broker-dealer, and that they're coming with new deals. I think we've got about 19 new deals, both private and public, coming with them, about $150 million in capital being raised from those deals as we bring those brokers over from another broker-dealer.
Okay, great. Let me ask you this. As a lot of people know, in 2008 and the rise and the fall of the stock market and traditional investments, as they kind of go up and down, the economy tends to trail behind that as a result. Would you say the alternatives are good, better, the same, something else as traditional methods of investing? As far as the economy goes, does it behoove people to put money toward an alternative versus something traditional, or does it have as much of an effect?
It's much more driven by the particular market space of the alternative investment, but generally I would argue alternative investments are less subject to the whims of the market than traditional investments. They can often be countercyclical. Many very successful companies were founded in recessions and downturns and bear markets. So it depends on the particular investment, and investors should look at investments on that basis. But I would say that generally the gains and losses in the alternative investment space are not as subject to market forces and direction as the rest of the market is.
And that actually kind of brings us full circle to the hype. One of those maybe hype things being that they cut and dry, black and white, are or are not better, when really it's not so easy of an answer.
It's not an easy answer, and that's why it's more difficult, and that's why fewer people participate in it, because it requires an eye for companies that are going to be successful when you don't have as many measurable indicia of their success. And so that's why this kind of investing is more difficult. It's usually in an earlier stage of a company's development than the companies that are listed on the public markets. But that's also why there's potentially greater reward in it, is that, all the phrases you've heard, getting in early, getting in on the ground floor, whatever metaphor you want to use, this is getting into a company usually when it's at an earlier stage of development. At OfferBoard, we've decided not to focus on, however, startups. So we don't generally list companies that haven't been operating before and that are trying to do something new. There are plenty of platforms out there that are focused on the startup community, and we're more focused on the growth sector. We're looking for companies that are raising more significant amounts of money, $2 to $25 million, that are in an emerging growth category, that are trying to commercialize or increase their distribution, or create a new location, or a new. They're trying to use that capital for a very particular growth activity, and so that's where our platform is focused. That's the kinds of investments that people will find on OfferBoard, and I hope your listeners will go to offerboard.com and register and look around.
Well, you read my mind. Thank you for taking the time to speak with Accredited Investor Markets Radio today, Chris. In fact, listeners can go to offerboard.com for more information about what you do and about you specifically and what Chris does. I appreciate you taking some time to talk with you. Is there anything you want to say to sort of wrap it up? One kind of final piece of advice, or even a restatement of our original topic, cutting through the hype, why accredited investors aren't investing in alternative investments?
Well, I would end it on the note that I think the premise of the topic is incorrect. I think that there are accredited investors who invest in alternative investments. I think that the changes, the regulatory changes, and the advent of platform-based investing are going to increase the number of accredited investors that participate in alternative investments. And I would encourage your listeners to go look, go find out, learn about alternative investments, find another accredited investor who's participated in them, and see if they're right for you.
Great. Well, thank you very much. You have been listening to Accredited Investor Markets Radio, a weekly podcast devoted to educating investors about the basics of investing in alternative assets. We hope you tune in next time. I'm your host, Alicia Purdy, and we'll talk soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.aimkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.aimkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.